Hello, everyone. So I'm the last flash talk before lunch, so we'll get through this together and then get some food. We're running a little behind schedule. My name's David Hernandez. The title of my flash talk is, Will U.S. Exceptionalism Continue for Global Equities? The agenda is focused on 4 areas. I will discuss the performance history between U.S. and non-U.S. equities, review the influences on that performance history, take a look at what's happened this year, what might happen over the next 3 to 5 years, and then wrap up with the points for and points against U.S. exceptionalism into the future. For context, I'm going to use the term global equity, and I'm using MSCI definitions here. MSCI is the institutional benchmark provider. Their global equity index is comprised of over 8,000 stocks across 47 different countries. 63% of that index is U.S. equities. 37% is non-U.S. equities. When you look at non-U.S. equities, you have developed markets, which are countries like Japan and Germany, and you have emerging markets, countries like Taiwan and Brazil. I will be discussing the performance history between U.S. and non-U.S. equities. Now, before I go any further, there is information that I need to disclose in the spirit of transparency. I am biased towards non-U.S. equities. I've been covering that asset class for more than 10 years now, and when you spend so much time on something, you start to become attached to it. You start to root for it. So the last 15 years have been very difficult for me because U.S. equities have kicked my asset class. The S&P 500 through December 2024 is up 603% cumulative. The non-U.S. developed benchmark is up 115%. That's a wide margin of outperformance. But if we go back to the 10 years previous to this, non-U.S. equities outperformed. The MSCI EM index up 154%. The S&P 500 was down 9%. Many market observers reference this as the lost decade for the S&P 500. So that's the last 25 years. Let's go back even further. Let's go back to the 50-plus year history, and we see that these two asset classes have taken turns outperforming each other, resulting in performance cycles. And these performance cycles have typically lasted anywhere from 3 to 10 years. The most recent cycle with U.S. equities outperforming is the longest we've seen at 15 years. So what I'm going to do is I'm going to talk about these performance cycles and the influences of these. I'm going to start in the 80s. It's one of my favorite decades. I'll tell you why that is in a couple of slides. But I'll start in the 80s and then make my way up to the present cycle. First, though, before I talk about specific cycles, there is a factor that is consistently influential throughout time, and that factor is currency. When the U.S. dollar is trending stronger, that is supportive of U.S. equity outperformance. When the U.S. dollar is trending weaker, that is supportive of non-U.S. equity outperformance. And the last 15 years, for most of that time period, U.S. dollar has been stronger, which has helped U.S. equities outperform. So the specific performance cycles will start in the 80s. I was born in September 1980 on a rainy day, and as I was compiling the materials and reading about the history in preparation for this presentation, I started to get these feelings of nostalgia. So I thought it would be fun not just to focus on the returns and performance, but to look back at pop culture during these time periods. So as I talk about these specific performance cycles, I'll start first with a look at pop culture, and then we'll talk about U.S. versus non-U.S. equities. So the first performance cycle is the 80s. This is the decade where greed is good. That is a quote from Gordon Gekko, the fictional character in the 1987 film Wall Street, starring Charlie Sheen, Daryl Hannah, and Michael Douglas. Now, this movie really highlighted the consumer and corporate culture that was prevalent in the United States. And materialism was a dominant value. Electronics like the Sony Walkman and Super Nintendo or Nintendo gaming system were common household items. Both these produced in Japan, more on that on the next slide. But I remember spending a lot of time trying to save the princess in Super Mario Brothers. And I remember other toys. I was a kid during the 80s, so I remember He-Man, She-Ra, My Little Pony, Kid Sister, My Buddy, Care Bears, as well as this collection of dolls that actually incited in-store riots during the 1983 holiday season. And the 80s were a strange time for some reason. A lot of people were dealing with having cold ankles, and that necessitated the use of ankle warmers. Still don't quite get that phenomenon. That's pop culture on the investment side. Non-U.S. equities outperform, and Japan was a key reason for that. That country experienced an asset price bubble. Real estate prices, equity prices, both moved higher through that decade. The government had accommodative policies in place. That country capitalized on global consumerism and its manufacturing prowess to export electronics, export automobiles to the rest of the world. That led to very strong equity returns, particularly in the middle of that decade. Asset price bubbles, though, have a tendency to pop. This one popped in 1990. Japanese equities were down 36%, and it would take more than 2+ decades before this market set another new all-time high. Next performance cycle is the 90s. This is the decade of the dot-com boom. Cell phones started to make their way into the mainstream, though they were often the sizes of brick. Bonus points if you can name the character from one of my all-time favorite 90s TV shows. Yes. Many of us got our first taste of the online experience via the internet boom. Do y'all remember those free trial CDs from AOL? We're in Chicago, great city of Chicago. I can't talk about 90s pop culture without talking about the 6-time NBA champion dynasty like no other, Chicago Bulls, led by the great Michael Jordan. I grew up in San Antonio, Texas, and even I wanted to be like Mike. Now, since I grew up in Texas, I can't talk about one great 90s team without talking about this great 90s team, America's team, the Dallas Cowboys. We got a lot of Philly fans here. At the end of the decade, I had my greatest all-time in-theater movie-going experience. I was on a date with my girlfriend, who would become my wife. That's not what made it so great. Don't tell her I said that. It was the storyline, it was the special effects, released in 1999. Any guesses? The Matrix. So this is pop culture. On the investment side of things, U.S. equities outperform, and the internet boom was a key reason for that. The technology sector at the start of the decade was less than 10% of the S&P 500. By the end of the decade, it was north of 30%. Valuation multiples doubled during this time period, and this led to Alan Greenspan, who was the Fed chairman at the time, to use the term irrational exuberance to describe asset pricing during this period. As I said, in Japan, asset price bubbles tend to pop. That happened in early 2000, and the next 10 years would result in challenged performance for the S&P 500. The next performance cycle is the 2000s. This is the decade when media turned social. Cell phones, 100% mainstream. Most people owned them by the end of the decade. Some of those cell phones had full keyboards like the BlackBerry and Sidekick. And we traded in our Sony Walkmans for Apple iPods and iPod minis, designed in the United States, manufactured in China. More on that on the next slide. We began to cultivate online friendships. And many of us here probably share a common first online friend. Do you remember this person's name? Similar to today, we use Netflix to watch our favorite TV shows, our favorite movies, but we had to wait 3 to 5 business days to do so. And viral videos went viral, including this 2007 gem. That's pop culture. On the investment side of things, non-U.S. equities outperform, and globalization was a key reason for that. The trends that were established in the 90s went further into the 2000s. You had NAFTA enacted in 94, World Trade Organization established in 95, China joined that organization in 2000, and then globalization peaked in 2008 if we measure it as global trade over global GDP. China became the world's manufacturing center. Manufacturing jobs left the US, went to China. That economy saw double-digit economic growth over a 2-decade span. Urbanization occurred. Citizens left rural areas, went to urban areas, which required an infrastructure build-out, which led to a commodity boom, and those things helped non-US equities outperform. The next performance cycle is more than a decade, so it takes up the 2010s as well as the 2020s, and I'll reference this period as the period for binging, streaming, and scrolling. On demand, we could watch any TV show we want. We can watch those critically acclaimed, all-time great, award-winning TV shows, including one of my top 3 all-time favorites, The Game of Thrones. We could also binge TV shows that are better described as guilty pleasures. In the 2000s, we cultivated online friendships. Now people are cultivating AI friendships. More on AI on the next slide. And we created a new language centered on emojis and acronyms, LOL, JK, IYK, YK, and influencer became a career aspiration for many of today's youths. So that is pop culture. On the investment side of things, U.S. equities have kicked my you-know-what. It's been a dominant run over the last 15 years, and I'll assign two overarching reasons for this. The first is a favorable policy environment, and the second is earnings growth. On the policy front, you've had historically low interest rates, post-COVID, post-global financial crisis, higher fiscal spending. The fiscal debt to GDP ratio surpassed 100%. You have more spending, lower interest rates. These are supportive of economic growth as well as corporate growth. And companies took advantage of that environment along with the technological and AI advancements to execute on earnings growth. And if we compare this time period to the 90s in a similar exercise as Catherine did, we see that yes, both time periods did see valuations expand, but that was a bigger part of the return story in the 90s. This time period, there's been stronger earnings growth and overall higher quality fundamentals. So those are the performance cycles. Next, let's talk about what's happened this year, what might happen over the next 3 to 5 years. And as I move through the rest of these charts, I will assign them as either being a point for U.S. exceptionalism or a point against U.S. exceptionalism, and at the end, we'll sum them up. So this year, great year. Non-U.S. equities are outperforming. If we look at the 12 largest countries in the global equity index, 11 of them are beating the U.S. You've got Spain, Italy, and Korea that generated returns north of 40% year-to-date through August. So why are they doing so well? Well, do you remember that consistent factor I talked about that's influential through time? That's currency. Currency has added 11% to developed market returns and 3% to emerging markets this year. And this is a very different story than what we've seen for most of the last 15 years. For example, last year, 2024, currencies detracted 7%. And if we look at the real effective exchange rate of the dollar versus a basket of currencies, despite the recent weakness from the dollar, it still trades more than one standard deviation above its historical averages. So all else being equal, over the next 3 to 5 years, dollar strength is less likely. This is a point against U.S. exceptionalism. Now, a second key reason why non-U.S. equities have outperformed is there's been a shift in investor sentiment, and that has especially occurred within Europe. In that region, the leaders have committed an additional 800 billion euros in defense spending. Now, this was largely the result of the U.S. and President Trump pulling back on its spending commitments in that region. And this is expected to have a positive impact, certainly on the defense sector, but other sectors, including software, electronics, telecom. It's also expected to have a boost to economic activity. And even outside of that, I think importantly, this signals the potential for improved coordination among European countries. And if that trend persists, that is likely to further strengthen investor sentiment. So this is a point against U.S. exceptionalism. Now, despite the strong returns from non-U.S. equities, U.S. equities are still out-earning their non-U.S. counterparts. If we take the year-to-date returns and we decompose them, break them apart into 4 factors, currency, earnings, valuation, and dividend, we see that currency appreciation and valuation expansion are the 2 key contributors for non-U.S. equity outperformance. Earnings growth marked in the green area of this chart is positive for non-U.S. equities, but it's much more positive for U.S. equities. And so if we're going to see further strong performance from non-U.S. equities, we need to see better earnings growth. This is a point for U.S. exceptionalism. Now, as Catherine mentioned, a lot of the earnings growth from the U.S. has come from a small cohort of stocks, and that represents the concentration that is happening within the U.S. within the global equity context. And I will cite 3 levels of concentration. The first is country. The U.S. is 63% of the global equity index. This is a recent all-time high. The next largest country is Japan at 4%. Second level of concentration is sector. While the U.S. is a large part of the global equity index, tech is a large part of the U.S., roughly a third of the S&P 500. Third level of concentration is stock. The 5 largest stocks in the global equity index, all U.S. companies, outweigh the 5 largest non-U.S. countries. In sum, 18.1 versus 16.3%. Now, this concentration issue doesn't make U.S. exceptionalism any less likely. But as Catherine said, it does pose a risk should one or some of these stocks misstep into the future. Importantly, though, I think it signifies that the U.S. companies are global market leaders with historical high profit margins, robust earnings expansion with presence in secular growth areas. So this is a point for U.S. exceptionalism. Now, that link between secular growth and the U.S. is not a new phenomenon. This has been in place since the 90s. Typically, U.S. equities do well when the growth style of investing does well, and typically non-U.S. equities do better when value is outperforming growth. And I think we can say with some confidence that the U.S. has been an outsized beneficiary of the AI and technological boom that we've seen over the last couple of years. But there's no guarantees that that's going to persist into the future. There are countries and companies outside the United States that are making significant investments in semiconductors and robotics and infrastructure build-out and artificial intelligence. For example, China holds a large percentage of the world's Gen AI model patents. Now, while the US will certainly remain a market leader, there is room for new winners to join the likes of TSMC from Taiwan and SAP from Germany. So this is a point against U.S. exceptionalism. Now, when we take a look at the foreign revenue exposures of the S&P 500, Catherine did a similar exercise. We see that 40% of the revenues come from outside the United States. If we look at the Mag 7, with the exception of Amazon, the foreign revenue exposure ranges from 49 to 64%. These are global market leaders, multinational companies, but this also represents a challenge in a world with higher tariffs, a challenge in a world with more complicated global relations and more complicated global supply chains. This is a point against U.S. exceptionalism. Now, another challenge facing the U.S. market is the fiscal spending outlook. I talked about the accommodative policies in place, low interest rates, high levels of fiscal spending. The average fiscal deficit in the U.S. over the last several years has been the largest or second largest in the world, with big jumps post-global financial crisis and big jumps post-COVID. How much longer can the U.S. run fiscal deficits, and how much more return juice is left from future fiscal spending? This is a point against U.S. exceptionalism. So with all that being said, will U.S. exceptionalism continue into the future? The points for U.S. exceptionalism largely center on company fundamentals and presence. By and large, U.S. management teams have made better capital decisions, leading to higher profit margins, stronger earnings growth. And U.S. companies are global market leaders with presence in high growth industries. The points against U.S. exceptionalism largely center on signs of improvement for non-U.S. markets and the higher and higher and higher bar that U.S. equities have set and continue to set. Many non-U.S. markets have taken steps to improve capital decision-making, shareholder friendliness, as well as policy coordination. And in the U.S., the higher valuations, higher expectations, and perhaps less friendly policy environment serve as challenges. So with all that being said, in my opinion, and remember it's a biased opinion, U.S. exceptionalism will continue from a fundamental perspective, but when we look at asset class returns with non-U.S. equities, the performance gap is likely to narrow. We can't be certain about the future, and I certainly can't predict the future, so having diversified exposure to both asset classes is likely prudent for most investors. Thank you for your time. I hope you found something useful. Next up will be lunch, where I'm hoping we do get some dessert, and then there will be a fireside chat shortly thereafter.